Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Thursday, June 18th, 2026. We're Elena and Marcus.
So imagine paying a massive premium to buy into a stock market where the central bank is, actively threatening to crush the broader economy.
Yeah, that is exactly the complex tug-of-war playing out across your screens today. I mean, if you're looking at the tape and struggling to reconcile the conflicting signals flashing across equities, rates, and commodities, you are definitely not alone.
Right, because we essentially have a Federal Reserve pulling the emergency brake and a tech sector stomping on the gas.
Exactly. Reconciling those conflicting realities is our primary mission today. Looking at today's proprietary updates, there are really three critical themes driving this session.
Yeah, first we're tracking the shockwaves from Fed Chair Kevin Warsh's surprisingly hawkish debut and the resulting credibility trade actively playing out in the bond markets.
Right. Second, there is this historic equity market bifurcation taking place. It's a massive structural divergence where AI hardware continues to boom while legacy IT services face a pretty sudden and brutal collapse.
And third, we are monitoring the U.S. dollar's sheer dominance, which is, currently crushing precious metals like gold and silver.
And these aren't just isolated random events, are they?
No, not at all. What we're observing today is a highly complex mechanical reaction to a shifting macroeconomic regime. I mean, the market is attempting to price in a central bank that's prioritizing inflation suppression above all else.
Right, but simultaneously investors are aggressively rewarding the few corporate sectors that can generate secular growth, regardless of how high the cost of capital actually goes.
Correct.
Well, let's start with the catalyst for this entire repricing, because everything else flowing through the system today traces right back to Washington. Moving to today's data, we need to examine the aftermath of Fed Chair Kevin Warsh's inaugural FOMC press conference.
Yeah, the dot plot shift from our daily desk data was far more aggressive than the street anticipated. 9 participants are now projecting an actual rate hike in 2026.
Which is a huge shift.
Sure.
And furthermore, the median projection for 2027 core PCE inflation was revised upward to 2.5%.
Right, so the market absorbed that hawkish rhetoric and is now pricing in a 38.5% probability of a rate hike in July 2026.
I'm looking at these probabilities and scratching my head a bit. I mean, we spent the last year debating when the cuts would start, and now we're pricing in a near 40% chance of a hike next month.
It's a massive pivot. That July probability is the single most important metric on the board right now.
Yeah.
Warsh's complete reluctance to provide any dovish forward guidance, it basically forced the institutional consensus to abandon the higher for longer complacency entirely.
So the new reality the market is digesting is that the next move could very well be a hike, not a cut.
Exactly. We saw record futures volume more than 4 times the 20-day average change hands as institutional traders rushed to position for this new baseline. When the Fed revises 2027 core inflation up to 2.5%, they're formally admitting they do not expect to hit their 2% target for years. And that structurally changes how you have to price risk across every single asset class.
Yeah, and we can clearly see the scars of that structural shift in the rates reaction. Front-end yields spiked violently yesterday following the press conference.
They did. Though today we saw the 2-year yield stage a partial recovery, dropping 3.5 basis points to settle at 4.181%.
Right, but it remains elevated, hovering near multi-year highs. Meanwhile, the 30-year yield actually rallied, dropping 2.9 basis points to 4.900%.
Yeah, which brings up an interesting dynamic.
It does, and if we apply a first principles lens here for a regular investor, this looks entirely contradictory. I mean, if the Federal Reserve is actively threatening to hike interest rates to restrict the economy, why are long-term borrowing costs actually falling today?
It's a vital question. And it comes down to a dynamic that dealer desks call the credibility trade.
Okay, let's break down the mechanics of that.
So, the 2-year yield is highly sensitive to immediate monetary policy. When the Fed signals imminent rate hikes, the 2-year naturally rises.
Right.
However, the 30-year yield does not track the immediate federal funds rate. It reflects long-term expectations for economic growth and, most importantly, inflation.
I see.
So by pushing short rates up and driving long rates down, the bond market is executing what we call a bear flattening of the yield curve.
Let's pause and unpack bear flattening for a second. That just means short-term rates are rising faster than long-term rates, effectively squeezing the spread between them, correct?
Precisely.
But why exactly does that specific dynamic happen here?
It happens because the bond market is sending a clear message. Investors believe the Warsh Fed is credible. They believe this specific central bank is willing to inflict near-term economic pain to successfully crush inflation over the long haul.
So if the Fed hikes today, they choke off growth and inflation tomorrow.
Yes. The falling 30-year yield is essentially the market's vote of confidence in Warsh's inflation-fighting commitment. The pain is entirely front-loaded in the short end of the curve.
So the bond market is basically saying, we hear your threat, we believe you will actually follow through on it, and because we trust you to kill inflation eventually, we don't need to demand a higher premium to hold long-term debt.
Correct. It is a textbook bear flattening dynamic that transitioned into a bull flattening recovery as today's session progressed.
Yeah.
And if we look at our latest run of global data, this hawkishness is not entirely isolated to the United States, though the mechanics differ by region.
Right. Looking at today's data deck, the Bank of England opted to hold rates today, despite a meaningful upside surprise in UK labor data where payrolls rose instead of falling.
Yeah. But on the continent, the Czech National Bank delivered a hawkish surprise of its own, hiking its benchmark by 25 basis points to 3.75%.
And they explicitly cited persistent domestic inflation pressures as the catalyst for that.
They did. That proves the final mile of inflation suppression is remaining sticky on a global scale.
Well, the Bank of England, the Czech National Bank, the Fed central banks across the globe are signaling tighter conditions. You would assume global equity markets would be plunging under the weight of those higher borrowing costs.
You would, yet they aren't.
On that point, let's look at how the equity market absorbed this hawkish rates shock. On the surface, the headline indices displayed remarkable resilience. The S&P 500 closed exactly at 7,500.58, which is up 1.09%.
And the NASDAQ 100 surged an impressive 2.48%.
Right. However, when you look under the hood at our daily data deck, the equal weight S&P 500 gained only 0.46%.
That spread is critical. For those tracking the internals, the equal weight index treats the smallest company in the S&P 500 the exact same as the largest mega-cap tech stock.
So when the cap-weighted S&P 500 is up more than double the equal weight version, it represents a massive gap in underlying performance. The average stock is barely treading water, while a handful of giants are flying.
Leadership is incredibly narrow right now.
Yeah, the breadth is razor thin.
Today's price action highlights an extreme structural bifurcation. The market is violently separating the tangible winners of the AI infrastructure build-out from the losers.
Let's look at the corporate movers from today's proprietary updates to see that in action. On the winning side, Micron delivered a blowout earnings report.
Yeah. Their results were driven by insatiable demand for high-bandwidth memory, or HBM, which is the critical bottleneck component for AI data center applications.
Because advanced AI processors require instantaneous access to massive amounts of data, right?
Exactly. And HBM provides that pipeline. Micron shares soared 8.7% on the print.
And that single earnings print pulled the entire semiconductor supply chain up with it. We saw SNDK jump 11.5%, INTC gained 10.6%, SMCI rose 10.4%, and KLAC added 8.7%.
Yeah, and this momentum even triggered a massive overnight rally in Asian market, pushing the Kospi up 2.30%.
Samsung and SK Hynix caught what traders call a read-through bid, right?
Right. For anyone unfamiliar with that term, it just means that when Micron posts spectacular numbers for memory chips, investors aggressively buy regional competitors like Samsung, assuming they're experiencing the exact same surge in demand.
So the market is indiscriminately rewarding companies that produce tangible, physical hardware for this infrastructure build-out.
It is. Conversely, though, we have to examine the destruction on the other side of this trade, because it's pretty severe. Accenture suffered an 18% collapse today.
Which is staggering. This is a premier blue-chip consulting firm, and a single-day drop of that magnitude is a direct result of AI-driven labor disruption finally showing up in the fundamentals.
Let's dig into the why there. So basically, investors are throwing money at the silicon and microchips, but they're running for the hills if your business model relies on actual human beings in suits billing by the hour.
Yeah, our data mentions agentic software models destroying the legacy IT model. Break down what that actually means for a company like Accenture.
Well, an agentic software model goes far beyond a simple chatbot that answers questions. It's an artificial intelligence system designed to execute complex, multi-step workflows autonomously.
Okay.
So if a corporation previously hired a team of junior consultants at Accenture to optimize global supply chain routing, a project that might take 3 months and cost millions, an agentic model can now run those same optimizations in minutes.
For a fraction of a cent.
Exactly. The market is actively pricing in the reality that generative AI is permanently destroying the traditional IT consulting business model.
And legacy services companies like CTSH and IBM were dragged down right alongside Accenture today.
It's a ruthless fundamental rotation. And institutional positioning reflects this deep conviction. According to our latest run, hedge fund net exposure is currently sitting at a 4-year high, placing it in the 89th percentile.
But that leverage isn't spread evenly across the broader market, is it?
No, it's heavily crowded into these specific AI hardware themes. Funds are completely ignoring traditional valuation metrics to chase this specific growth vector.
Which brings us to a crucial divergence hiding in the corporate debt markets today. While equity investors celebrate the semiconductor boom, the credit data in our daily desk data is flashing a severe warning sign regarding the broader economy.
Yeah, investment grade and BB cash spreads remain incredibly tight. They're sitting near post-financial crisis lows, meaning high-quality companies are borrowing easily.
But CCC spreads have completely blown out. They hit 766 basis points today, which is a 1-year high.
For anyone not living on an institutional credit desk, CCC is effectively the basement of corporate debt. These are the highly leveraged companies barely hanging on.
And today, the cost for them to borrow money or refinance just hit a 1-year high. Walk us through the mechanics of why that specific tier of debt is fracturing right now.
That spread widening is a direct consequence of the Warsh Fed's hawkish stance colliding with harsh corporate realities. A CCC-rated company typically relies heavily on floating rate debt, or they require near-term refinancing just to maintain operations. When the Federal Reserve signals that the cost of capital will remain elevated, or even increase like we saw with the July HEC probabilities, those lower-quality companies face a mathematical wall. The interest expense simply outpaces their cash flow.
So investors are demanding significantly more yield to hold that debt because the risk of a formal restructuring or outright default is rising rapidly.
Correct, even while the broader S&P 500 hits new all-time highs.
Understood. Moving over to the commodity space, we are seeing those same hawkish fractures play out in hard assets. Gold plunged 1.10%, closing at $4,209.97 per ounce.
And silver took an even heavier hit, plummeting 3.32%.
Yeah, for assets traditionally viewed as safe havens or standard inflation hedges, today was a deeply brutal session.
It really was. The severe sell-off in precious metals is the direct mechanical result of the Warsh Fed repricing we discussed earlier. The U.S. dollar index, the DXY, have extended a 1% rally over the last 2 days.
And simultaneously, real rates are climbing.
Right. To understand the mechanics here, remember that a real rate is just the nominal treasury yield minus expected inflation.
Okay.
Gold yields absolutely nothing. It pays no dividend. It produces no cash flow. Therefore, it is hypersensitive to moves in real yields.
Right. It comes down to basic opportunity cost. If you can get a guaranteed, risk-free real return on cash or U.S. treasuries, and the dollar itself is strengthening, the cost of holding a dormant asset like gold becomes far too high for institutional portfolios.
Exactly. The metal simply buckled under the weight of that stronger dollar and rising real rate environment.
But what about silver's outsized drop? I mean, falling 3.32% suggests there's more at play than just currency dynamics.
You have to factor in the dual nature of silver. It acts as both a monetary asset and an industrial metal used heavily in manufacturing and electronics.
Ah, right.
When the central bank threatens to hike rates, they're intentionally trying to slow down the broader economy. Higher borrowing costs choke off global manufacturing demand.
So silver is getting hit on two fronts simultaneously. The monetary side is suffering from the strong dollar, and the industrial side is suffering from the threat of an engineered economic slowdown.
Correct.
While metals suffered, we did see energy act as a crucial stabilizing force for the broader market today. WTI and Brent crude saw a very modest technical bounce, between 0.6% and 0.8%.
Yeah, but WTI remains heavily suppressed, hovering right around $76.35 per barrel.
Given the hawkish shock we just absorbed, why is oil staying so cheap?
That suppressed oil price is perhaps the most important macroeconomic factor, allowing the equity market to maintain its current premium valuations.
Because of the geopolitical driver, right?
Yeah, the formal U.S.-Iran agreement to reopen the Strait of Hormuz, which was finalized over the prior weekend, roughly 20% of global oil consumption passes through that specific choke point.
So that agreement removed a massive lingering geopolitical risk premium from the energy market.
It did, acting as a profound disinflationary relief valve.
It acts essentially as a massive global tax cut for the consumer and provides immediate margin relief for corporate supply chains.
Cheaper oil is the exact reason the equity market was able to shrug off the Fed's hawkish rate hike threats today.
Yeah, if oil was still trading above $100 a barrel while Kevin Warsh was simultaneously threatening to hike interest rates, we would likely be looking at a much darker, highly recessionary equity tape today.
The timing of the Hormuz Agreement provided the exact macroeconomic cushion the market required to absorb the FOMC shock. It suppressed headline inflation fears just enough to let institutional investors focus on idiosyncratic corporate earnings.
Like the Micron semiconductor beat.
Right, rather than panicking over broad systemic risk.
So the timing of that geopolitical agreement is effectively subsidizing the entire AI infrastructure build-out.
Indeed.
It is time to connect the dots across all of these asset classes based on today's proprietary updates. We have a highly hawkish Federal Reserve driving the U.S. dollar up and gold down.
We have cheap crude oil actively suppressing headline inflation fears.
And we have massive localized equity winners being driven entirely by AI capital expenditures, while legacy IT services completely collapse.
Synthesizing this data, we can define our current economic environment as a soft landing with a hawkish overlay. The market is making a very specific, narrow bet right now.
Which is?
It's betting that corporate growth, specifically the secular growth led by AI infrastructure spending, is strong enough to easily absorb the higher cost of capital dictated by the Fed.
And simultaneously, the market is betting that energy-driven disinflation will lower headline numbers just enough to validate Kevin Warsh's inflation-fighting credibility without requiring a severe recessionary shock.
Correct.
To help visualize this specific market regime, think of the broader market right now as a commercial airliner flying straight into a severe thunderstorm. That thunderstorm is the hawkish Federal Reserve, threatening higher interest rates and much tighter financial conditions.
Yeah, and by all standard physics, the plane should be losing altitude rapidly.
Right, but it isn't dropping out of the sky because it's being kept aloft by two massive tailwinds overriding those downdrafts. The first is the jet stream of AI hardware spending we discussed, which is generating unprecedented earnings growth for a select few mega-cap companies.
And the second tailwind is the sudden steep drop in fuel prices due to the Strait of Hormuz reopening, which is keeping the economic engines running efficiently.
Exactly. But if you listen closely, you can hear a violent rattling down in the cargo hold. That rattling is the blowing out of CCC credit spreads we discussed earlier.
Yeah.
It proves that while the plane is still flying high on the headline indices, the weakest, most heavily leveraged passengers down below are already feeling severe turbulence.
That is a highly accurate representation of the divergence we're tracking across our daily desk data. The headline indices show smooth altitude, but the internal credit mechanics reveal intense, building pressure on the weakest links in the corporate chain.
Which brings us to a final thought for you to ponder regarding this specific structural divergence. We've thoroughly discussed the institutional capital flowing rapidly into AI hardware and flowing aggressively out of legacy IT services.
But consider the vast difference in the human labor footprint between today's market winners and today's market losers.
The disparity is pretty staggering when you look at the real-world implications.
It is. The AI hardware companies, the semiconductor fabricators, the memory chip designers like Micron employ a relatively small, highly specialized, capital-intensive workforce.
On the other hand, the legacy IT services and consulting companies that are currently getting disrupted by agentic software employ hundreds of thousands of people globally.
As this AI transition accelerates and traditional consulting bookings continue to decline, we're looking at a silent, building wave of white-collar labor disruption.
Yeah.
The question this raises is critical. Will this impending wave of corporate job displacement eventually generate enough economic drag to force the Warsh Fed to abandon its aggressively hawkish stance and pivot back to easing?
It is a critical dynamic to watch as the year progresses and those labor metrics start hitting the tape. Thank you for listening to Market Pulse by Orestes Capital. We're Lena and Marcus. We'll be back next week with the latest market color. Happy Juneteenth. Happy Father's Day to all the dads. Have an enjoyable weekend.